Doc Severson with you here. Thursday, the 15th. Welcome to Trade School. Today we're going to be talking about Elliott Wave. Elliott Wave. So many of you may never have heard of Elliott Wave before, and so I will demystify that for you. Well, I'm going to try to keep it simple for you, because the one thing that I've noticed about Elliott Wave is that you can completely go over the top and complicate this, and I think that's one of the biggest mistakes that you can make with this. If you understand the basics of Elliott Wave, I think you may have a leg up, because it dovetails right along with the structure that we teach in terms of price action and higher highs and higher lows and lower highs and lower lows and all the price action like that. How we doing out there? How's everybody surviving the crypto crash of the latter half of fourth quarter 2018? So range contraction leads to range expansion. This is what's supposed to happen. So this is actually good. I think I'd feel a little bit odd if we rallied from the recent lack of volatility, right? So if we just rallied up from the sideways tape that we have, I would have to respect it. And this is what I was saying a week or two ago, like, okay, if it's going to go higher, I have to respect that. But my sense is that any rally to the upside would probably fail and get pushed underwater. Remember, markets will move in a way to separate the greatest amount of cash from the largest number of participants. And that's, I think, what we've seen in the last couple of days. So let's get into Elliott Wave. And before I get going on Elliott Wave, I do want to say I am not an expert on Elliott Wave. I know a little bit about it, and frankly, I learned just enough about it to realize that, okay, I get the main point of this. I don't want to go any further. So there's sometimes that you want to, and I know that this is backwards, but here is kind of the book that's out there. In this book, let's see, when was this thing published? This is the Frost and Prechter book, and this came out in 1978. You can undoubtedly find this used on Amazon for probably just a few bucks. And that's, I would not get it unless you are desperate to learn more about this. You can find a lot of stuff online about Elliott Wave. And I want to caution you, hey, Tig, I want to caution you that if you start to dig into Elliott Wave, it's one of those, it's one of those never-ending holes that you can get yourself drawn into, that you dig and dig and dig, and you're learning more and more about something. And then the more that you learn about, the more you find these arcane rules that are extremely tedious. And it can be very, very difficult. And I look at a lot of the Elliott waivers that are out there that are predicting markets based on Elliott Wave, and they're always wrong. And I think because of this, they're using it the wrong way. Well, anyway, I'm getting into the religion here. So again, before I get into this, a few disclaimers. The Elliott Wave principle is meant to be an exacting, rigid methodology with which one can analyze price movements in markets. I think it's great for that purpose. I think if you stick to that function of Elliott Wave, I think you'll be good. And I think you'll see things that you may not have seen before. Where I have a problem is when these analysts are devotees, or, they take it into this religious domain of Elliott Wave and they do forecasting or future projections. And I think anytime that you get into the business of forecasting or future projections, that's where you have trouble. So waivers, Elliott waivers, believe in this theory so much that they're constantly out on a limb saying, oh, we're in subminuet 5 of wave 5, so therefore the market's going to crash. Guaranteed the market's going to crash here in the next 2 to 3 weeks. And so it seems like they're always out on these crazy limbs, like, really, dude? And then the market just rolls right over them. And I've just seen it so many times over the last 20 years that I just tune it out now. But with that said, I do like the principle that I'm going to talk about today. So as we all know, retail customers love when people make predictions, when people say, this is going to happen, definitely for sure. They love that because most retail traders don't know any difference. And actually hearing predictions like that will subconsciously give you a little bit of a bias, which is not good. So I believe it to be harmful. So they will make it fit no matter what. They'll make that square peg jam into a round hole. Oh yeah, definitely this is wave 5. You know, whatever they have to do to kind of like reverse engineer a rally. So today, I'm not going to go down that route. I'm going to show you just enough to get started, or if you know a little bit about it, you may know a little bit more about it after listening to me today. In my humble opinion, a lot of people don't know what IMHO is. So in my humble opinion, that's where you should leave it. And that's just me. Use Elliott Wave as one more tool in your toolbox. So Batman's got that big belt and he's got all kinds of tools and he always has the right tool available for him. Elliott Wave is just another tool that you can use and is not the be all and end all of all TA tools. As we all know, price is that. So let's go into some vocabulary here. I don't have any charts. All I'm going to do is I'm going to draw things out for you freehand on the screen. That's all we need to do today because I want you to keep this as simple as possible. So there's two things. When I say motive, if we have an uptrend, which is going in this direction, a motive wave is going to be a wave or a swing that goes in that direction. This is a corrective swing. Motive, corrective. Motive, corrective. And if we look at this entire trend here, if we look at this guy, this entire thing from tip to tail, this is a motive wave, right? This is a motive trend to the upside. Now we also have corrective. Corrective will come into play when we get into the ABC. So we're not doing that just yet, but this is a corrective wave. This is going against the current trend. And so this element over here, this is corrective. All right, so this is corrective. This element right in here, because it's going against. So motive and corrective. Those are the only two words we have to learn. Here's the 5-wave pattern. And this is something that I believe you ought to memorize. I think this is actually worthwhile. What you'll find is that you'll see this over and over again. I see this intraday. I see this on swing chart basis. I see this in hourly charts. I see this in weekly charts. Doesn't matter. It's all over the place. Okay. So when we call this a 5-wave pattern, here's wave 1, 2, 3. Notice the number 3 is a little bit longer. Here's 4. And then finally 5. So this is 5. So this is the 5-wave pattern. 1, 2, 3, 4, and 5. Notice that the motive waves here, the motive waves are 1, 3, and 5. 1, 3, and 5. This is the 5-wave pattern. So just think about this. 1, 2, 3, 4, 5. We'll get into the structure in this in just a minute here. So who creates this 5-wave pattern? I'm going to draw the 5-wave pattern again. 1, 2, 3, 4, 5. What creates the 5-wave pattern? What I want you to think of this is that the 5-wave pattern starts from some kind of corrective move. So it's trending to the downside. People are unhappy, right? We're in the disgust phase, right? Disgust phase, everybody's unhappy. And all of a sudden, wave 1 comes along. Now, you might have also heard me talk about wave 1 as being the disbelief rally. This is where the smart money is coming on board. This is the smart money. This is not retail buying down here. Retail is actually starting to sell down in this area, and they're getting squeezed out to the upside. So wave 1 is the smart money. These are people that have been in the market for a long, long period of time. These are generally institutions that are These are hedge funds. These are people that are willing to look for the more aggressive bets in the market. Now, at some point, people that get involved in wave one are either going to take profits, or the former bears are going to establish dominance again temporarily. So that's wave two. And wave two is a corrective wave, because now we've started to change polarity to an uptrend. Along comes wave three. And wave three is what I will call just institutional money. So these are more of the whales. These are the bigger money investors. Notice that I haven't said that retail's on board yet. Retail is not on board yet, because retail tends to look back. Retail looks back and says, oh, this is scary. This is scary stuff. And they don't believe this rally that comes up. And they see this pullback here, and they think, oh, here goes the downtrend all over again. And this is called recency bias. Recency bias. We still have people that are looking back to 2008 and looking for the next financial crisis. Like any red candle is the next financial crisis, right? So the last 10 years they've been looking over their shoulder. This is called recency bias. So that's what you'll find is that the market has no memory at all. It has no memory. Doesn't really care what just happened. It's forward looking. Okay, so recency bias. That means that there's no retail customers on board yet, or very few of them. Maybe only some select few that are more grizzled, have more experience, right? So institutional money is typically stepping in somewhere down here and saying, thank you very much. We'll take that pullback, and then boom, big money. And this is why typically a lot of times wave three can be really strong, can be the strongest of the three. So that's one thing you'll hear about with Elliott Wave, is that it's common for wave three to be longer than wave one or wave five. And they've got their own set of rules around it. Must be longer than this and X and so forth. And, again, it gets to the point, it just gets to be mind numbing to the point where my eyeballs roll back into my forehead. I'm like, come on. So just understand that wave three is typically the longest one of them. And it's also because, if you think about it, many people missed out on the short opportunity. They see the bounce back up and they start to short here. And so there's a lot of weak hands. I'll put the weak hands, WH. Weak hands get squeezed out to the upside. All of a sudden, people can't believe it. It's an uptrend now. So by the time that you get up to wave four, so at some point, somebody's going to take profits. Wave four can be really choppy because the bears are like, oh, okay, should we do this? And the bulls are trying to get on board, and eventually wave five comes along. And wave five is retail money. Wave five is retail money. Retail always gets in last. Retail always waits until things feel good before they get on board. So this is the who behind the five wave pattern. So there's some real herd psychology behind how this all works, which is why I like it. I like the structure of the five wave pattern. Now, is it possible that you could see something like this? Six and seven? Absolutely. I see it all the time. When we have these huge, enormous primary uptrends in some markets, and we can find this, I'm sure, in Bitcoin, that we'll have like wave five, wave seven, wave nine. It just goes on and on and on, right? So especially as it goes completely parabolic. So this is why sometimes I think it's a little bit too rigid to structure it into five waves, because sometimes you can see more than that. So that's why I would not be shorting at the top of wave five just because it's wave five. That's too rigid. Okay, if you guys have any questions, let me know as I go through this. So that is who creates the five-wave program, or the five-wave pattern. Now we're going to go into the 3-wave corrective phase. All right, so we have 1, 2, 3, 4, 5, and then typically is A, B, C. So I will call these, so A, B, and then C. And there's a whole system in Elliott Wave versus using small letters versus capitals and things like that, you know, subminuets and everything. It can get to be very, very confusing. So 1, 2, 3, 4, 5, ABC. Notice that if I were to, and let me do this, let me see if I can find a window that I can pull up here, because this will make more sense for you guys. I'm going to bring up Mr. Notepad. Oh, and he's not going to let me do it. I can't do it. Okay, so I'm going to have to improvise. Let's say that all you can see is this area here. So you can't see anything. Doesn't this look like the beginning of the next move up? Remember me talking to you guys about the nasty lower high. Look at this. There's the nasty lower high. Everybody at this point, wave 5 is like most of retail got on there, and a lot of retail did not get on. And so they're like, oh, I can't believe I missed it. I'm definitely going to take the next pullback. And so they get on board the next pullback, and then all of a sudden, all these institutions say, time to sell into the rally. And all of a sudden, the legs come out from underneath this thing. That's why wave C is the strongest and the biggest of the corrective phase. So 1, 2, 3, 4, 5, motive, ABC, corrective. Got that? 1, 2, 3, 4, 5, Elliott Wave, pattern, motive, ABC, corrective. That's it. 1, 2, 3, 4, 5, ABC. Okay, so that's all you need to know. That's all you need to know about this. So motive plus corrective is what they call the entire market cycle. So 1, 2, 3, 4, 5, A, B, C. 1, 2. I'm being unnecessarily repetitive here, but repetition is the mother of skill. And then there's A, B, and then C. That's it. That is the entire market cycle. And then it begins again, typically. 1, 2, 3, 4, 5, A, B, C. And then it happens again after that in a larger time frame uptrend. So this is the entire market cycle. And what you'll also find, and this is what I think is really cool. So within this, all right, so let's draw 1, 2, 3, 4, 5, A, B, C. Within this, and this is consistent with what I taught in the Fractal Energy Program class, what you'll have is that you'll see at a smaller time frame, you'll see 1, 2, 3, 4, 5, A, B, C. 1, 2, 3, 4, 5, A, B, C. 1, 2, 3, 4, 5, A, B, C. 1, 2, 3, 4, 5, A, B, C, like that. So this is where you see waves within the waves. This is where you can envision the red as being the anchor chart, right? Remember, with fractal energy trading, we're always trying to trade within the anchor chart swing. Always trade in the direction of the anchor chart swing, right? So think of it as a poem. We're always trying to trade in that direction. And then what we can do is we can use the signal chart. The signal charts are represented by the yellow. Okay, so we're going to play within the swing here on this one. We're going to play within the swing on this one, right? So we're going to go in this direction and we're going to look for entries here, entries here. Here's another entry, here's another entry, here's another entry. We're going in this direction, right? So this is that fractal nature. So this is where I like Elliott Wave, and Elliott Wave is sort of tied in with the nature of fractal trading because you have waves within waves. So Tig is saying, at what point do you know that it's an Elliott wave that is forming? Well, all of these are just waves. It's the Elliott wave structure. So these are not Elliott waves. This is the whole thing is the structure of the Elliott wave pattern. So you know that a wave is forming, right? As remember, rule number one is that larger time frames dominate the trend. Rule number two is that reversals start from the inside out, right? So before this one is going to reverse up here, before this reverses up here, we print a lower high and then a lower low. This one's reversing here. So it's the same old rules in price action. Oh, there we go. So Bryce has got Bryce has got all the rules down. I don't know the Elliott Wave rules. As soon as they go into the rules, it's like I don't want to know their version of it. I don't want to know their version of it. I understand how price action works in my world, and I don't want to know what they do. I don't want to like cloud my vision of that. Okay, let's see what else I got. So how can we use the Elliott Wave theory? Well, there's a lot of ways that we can do this. So first of all, I really like the whole notion of this. When we have a primary trend that's kicking in on the anchor chart, I will typically see that primary trend will typically go for the 5 cycles. Sometimes more, rarely less than that. Rarely less than that. Now, what you're going to find is when you start going back in charts, you're going to say, hey, wait a minute. That's not an Elliott Wave pattern because maybe it didn't pull back that far, or sometimes the wave 3 is short and terminated and wave 5 goes crazy. And, you're going to just find that not everything fits nicely into their definition of how markets should move. And price is price. Price can do whatever it wants to. Right? So I do like the 5-wave theory, and I like how the reversal sets up with a lower high. Love that. That's great because it shows how getting the majority of the weak hands on the wrong side sweeps it out from underneath them. It fits perfectly in with what I talk about in price action. What I also like is how the moves within the moves are featured. The moves within the moves. So this goes right in line with what I do, or anybody else does that does multiple time frame price analysis like this, is that Elliott Wave is a great basis for that. Now, what I teach in fractal energy trading is that we don't talk about wave 5 or wave 3 or wave 1 or anything like that. We just say, hey, it's going to go until it reverses, and reversals come from the inside out. They come from smaller time frames. And so we don't have a notion of when we think that this thing should reverse. And so don't be careful about getting too didactic with these rules. That's one thing I would say. Okay, but I see this. What I would recommend that you do is go out to a chart and start to identify some of these waves. In other words, let's see, I don't think I have anything else here. So we can start to go over this right now. Let's see. Let's go into Bitcoin, and don't really have the structure here on some of the smaller time frame charts, but we can go out to, so you're going to look at this and you're going to say, well, this doesn't make any sense. But like this swing here, we sort of have, like here's a good example of a 5-wave series right here. So This is like 1, 2, 3, 4, 5. I mean, you can interpret this in a lot of different ways. Here we go. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. And then you're going to see things like this. You're going to see like a swing which just goes straight down like that. And you're going to say, wait a minute, Doc, there's no structure in there. And I'm going to say, yep, you're right. There is no structure in there. And then you're going to look at this one and say, there's no structure here. And I'm going to say, yep, you're right. So just because Elliott Wave exists doesn't mean that the price has to fit within that structure. So here's one where we could say, well, you know, and again, this is curve fitting. I'm curve fitting here. I'm cheating. I'm looking at this and saying 1, 2, 3, 4, 5, because I'm trying to fit 5 into there, but there's actually 7. There's actually 7 waves into this one here, right? So take it with a grain of salt, right? Understand that things are going to be different no matter which way you look at this. But I think that once you start to understand the Elliott Wave structure, you're going to say, oh, there's 5 waves there. Okay. Now, where's the 5 waves inside of this one? I don't know. I mean, you get into a parabolic trend, good luck trying to find structure in that. It's all emotion inside of that. It's all emotion inside of that. Okay, so with that, let's see. Let me know if there's any questions. I'm going to go back and look and see if I can find any structure here that we can. So here's a good example of a 5-wave series. This is really good. So here we come. You know, we're doing a version of ABC here. There's your ABC, and then here comes wave 1, wave 2, wave 3. Notice how wave 3 is much longer. Wave 4, 5, A, B, C. Here we go again. 1, 2, right? So you can go back and look at this and start to pick out the structure here. Now, again, I warn you guys, don't use Elliott Wave to be predictive. Just understand why things move the way that they do, right? Or what you might want to do is to say, if you're on wave 5, if you're entering wave 5, maybe you tighten those stops up a little bit. Maybe you don't look for such a big swing from a wave 5. And this goes to something that I've had to learn the hard way. The more that you focus on getting early entries, remember, our goal is to be smart money. We want to be smart money and keep working towards getting the smart money, because the smart money, you know, you look at something like this and it's like, would you rather be on board the trend down here or trying to fight for scraps up here? I mean, would you rather be entering at 2,700 and going long, or 4,400 and going long? And I know what the answer is, right? You want to find those wave 3s. You want to get, it's really difficult to get on board the wave 1 entries, because the wave 1 entries are not very obvious. It's usually after, as you get into wave 3. So your first goal is not necessarily to get on wave 1. Your first goal should be to stop entering on wave 5 and expecting so much from it, and start to find ways to get on board in wave 3. Go against your gut feelings that says, wait, that's scary, wave 3 is scary. You know, the wave 2 pullback doesn't feel good. And you can prove that to yourself. Here's the wave 2 pullback. It looks like it's starting to fail here. Here it is, it's pulling back, and it looks like it's setting up a lower high, and oh no, the world is coming to an end, and all of a sudden, boom, and you're not on board. You're not on board. So try to find ways to get on that wave 2 to wave 3 transition. Yeah, I'm curve fitting like crazy right now. So Tig, if Elliott waves are formed by different types of people getting on it, are some time frames more likely to show? Well, look, everything's got Elliott waves in it. Everything is a wave structure. So if we go out to the weekly chart, everything is wave structure on the weekly chart too. And why isn't this one? Why is this so ugly? Oh, that's 2014. That's why. That's the reason why. So you can go out in the weekly chart. Look at the weekly chart. Wave 1, 2, 3, 4, 5, right? So there's waves everywhere. There's waves on the 5-minute chart. There's waves, you know, so I mean you can go down to like an hourly chart and you can say, okay, here's wave 1, 2, 3, 4, 5. There we go. There's 1, 2, 3, 4, 5. And who's doing those? Well, it's everybody, right? So there's no one time frame that's going to show waves more than another because it's just the way that markets work. So you're seeing the same, you know, like here we go. Here's a rally. Here's a rally coming up. And the smart money's going to say, well, okay, smart money, let's draw a trend line here. All right, so we have a trend line and we're going to say, we're going to look for, oh, let me fix this. Okay, so there's a trend line. The smart money's not going to look to go long here. The smart money's going, I want to go short as soon as this thing fails. And it's going to happen off of a lower high. And then boom, here it is. So there's the smart money gunning on board. And this is the ABC correction that's coming on board. And then so, you know, there's your big wave 3 going right there. Right? So what's happening is the retail money is not aware of this. They're like, wait, what just happened here? I was trying to go long and all of a sudden I got my knees chopped off. And so retail money is going to wait until here before they go short. And again, this is the hourly chart. This is the hourly chart. And there's not much meat left that's on that bone. So all of us need to be looking to shift our entries sooner and sooner and sooner, and getting more aggressive entries and better reward to risk entries instead of chasing after wave 5s. Retail chases after wave 5. It is just a fact of life. And the sooner that you get your entries off of wave 5 and closer to wave 3, which is not going to feel good, the better performance that you're going to have. Okay, guys, anything else? Again, this is just scratching the surface, and I'm really hesitant to tell you guys to go dive into this because this will instantly make you a much more profitable trader. I think Elliott Wave, the principle, I love the whole principle. I love the 5-wave pattern, and that's it. Don't take it any further than that, or at least that's my advice. You can ignore that, but you know, people that go too far and too deep into this and have that belief, well, it's the 5th sub-minuet on wave 5, so it has to crash from here. That's where I see people getting destroyed in this, and that's not what you should be doing, right? So we're not in this to use TA to predict the future. We are here to look for an edge and to let price steer us in the direction that we should be trading. Yep. So Bryce understands kind of the waves within the waves thing. So he's spitting out some good wisdom here. So you're looking to get on wave 3 based on the first higher high of the 5-wave pattern. Right? So like, yeah, like if you look at this, Tig, I'm generally not looking to get on wave 1 because wave 1 is right there. So when this thing reverses, this is the old motive. And then as this flips polarity, this then becomes, this is the reversal here. So you can either call this ABC, or I prefer to call this wave 1 of the new trend down. This is now a new motive trend to the downside. And you're going to see this more on intraday charts. So you'll see just true reversals up, down, 5 waves up, 5 waves down. So it's a lot less of the 5 waves up and then ABC type of thing. More of the 5 waves up, ABC, you're going to see more on larger time frames that are more widely followed. So I think it's, looking at this, I think it's actually fairly aggressive to try to get in on wave 1 here. I would much rather wait until not only the trend line breaks, but also the price makes a lower high, lower low. You have a full change in polarity right here, right there at 64.40 is where the change in polarity occurs. That's the short signal. Now you're getting in on wave 3 or wave C. It could be either one, right? It's either going to be ABC or it's wave 3. Either of the two are really the same thing. So if I wanted to, the stop would be, if I entered short here, my stop would be above right there. So that's what I'm risking on it. And so if I take this one step further, then, you know, if I'm trying to enter on wave 5, this is all I've got left on wave 5. That's it. That's the only potential on wave 5. So try to get wave 3 when you can. Or right now, if you've never heard of this before, make your focus to try to get on wave 3, because that's going to be your best bet. It's not going to feel good. That's the one thing that you've got to get over as a trader is your feelings do not belong. What you'll find is that the better entries that you'll ever make are the ones that necessarily don't feel good, because it doesn't feel good to enter at this point. Because, like, here's an example. Everything's going higher, right? Boom, da boom, da boom, da boom. Everything's going higher. But a professional trader will look at this and say, rising patterns break to the downside. I want to look for this thing to pop in a lower high, and then the lower low will catch a lot of people off guard. And so here you go. Here's, let's see, this is wave 1, 2, 3, 4, 5. So this thing is already starting to correct. This thing is already starting to correct. You don't count the waves, though. Don't count the waves. All right. So any other questions? Anything else? That's Elliott Wave. I'll let you guys take it from here. Again, guys, I am not an expert on Elliott Wave. I understand the structure behind it. I understand how motive leads to corrective. I understand the 5 waves. I understand what makes each wave tick. That's really all you need. And understanding that waves within the waves is really the same thing that I talk about in the fractal program with the anchor chart versus the signal chart. So there's a lot of overlap here. Just don't take it too far. Don't get religious with this stuff. Don't do forecasting based on TA. That's where you get into trouble. All right. I think we have cleared the decks. So guys, wanted to thank you for hanging out with me here today. And let me know what we can do for trade school tomorrow. We'll see you guys then. Take care. There goes a sight from my soul. There goes a sight, there goes a sight. Now there goes a sight from my soul. There goes a sight from my soul.